Hello, everyone. Welcome to our webinar today. I'll just give it a few minutes.
This meeting is being recorded.
I'll just give it a few minutes while our attendees stream in. As that little message attests to, this will be recorded. So if you do miss it or you do have to drop out at any point, you can come back and see it on our YouTube channel on Superhero. I'll just give it 30 more seconds while people stream in. I can see our attendees coming in now. Thanks for joining us today, Tuesday lunch. Really exciting webinar coming up. Really excited to get into it with you and with Global X as well. So without further ado, we are looking at investing in the future today. We are looking at the various sort of new technologies coming down the pipeline, whether it's, green metals, battery tech, lithium, all of those kind of themes that, we do talk about quite a bit here at Superhero. And today we're lucky enough to be joined by Global X, a Australian ETF manager and formerly ETF Securities. If anyone is familiar there, who've recently gone through a rebrand. So we're joined today by Head of Investment, Blair Hannon. Blair, thanks for joining us.
Jack, really appreciate it.
Yeah, so if you could just flick to the next slide for me, Blair, I'll just quickly run through our own disclaimer. So this webinar is sponsored and presented by Global X. Superhero does not provide financial advice that considers your personal objectives. So just consider that during the presentation. Past performance, of course, is not indicative of future performance. So Blair, I'll throw it over to you to run us through the presentation you have today, and we'll go from there.
Yeah, thanks, Jack. So unfortunately, we've got to do a quick disclaimer as well, but I won't, like Jack, read that whole one out. It's there. Look, there's obviously no advice. This is very much general advice in nature, so we're not taking into consideration your personal situation. And I don't think we're really going to delve down that deep into these sort of ideas anyway, but we want to make sure that you're aware of that. So as Jack said, let me just give you a quick overview of who Global X is. I think the pertinent idea here is that, yes, previously in Australia, it was ETF Securities. We as Global X, merged and acquired that business sort of, earlier this year, and did a rebrand. So, but Global X is obviously much bigger than that. So for those of you who aren't aware, Global X is a US headquartered ETF business. As you can see on the screen there, it's in now across sort of six areas, six sort of major ETF markets, and that 41 billion is US dollars. So it's sort of circa, mid 50s billion of Australian dollars across a range of ETFs. Without going into huge amounts of detail on this, we were owned by another company at the top end called Meri Asset, which is a South Korean company. They own a range of different companies and have around just under 450 billion US dollars in management as well. So really well and strongly backed, which is important, I think, in this market, because we know with the likes of the Vanguards, the iShares, these sort of, it really is about having scale in the ETF market. But what are we known for? I think this is the probably important part of the ETF Securities acquisition as well. Global X is really known for thematic investing. It's known for things like commodity investing, income investing, or sort of what we call alternative income investing. And that really worked well with the ability to pair with ETF Securities, which really strongly represented in those areas as well. So the acquisition was, really synergistic. The two businesses work really well together. And now, as that Global X brand, we can sort of, really work towards bringing some of those US-based strategies and other area strategies to Australia to be able to provide you as investors with better opportunities around investing in certain areas of the market, and including, what we're going to talk about today around the thematic side. So to kick it off, as I said, what are the areas that we focus heavily on is the thematic investing space. And I'm going to give you, before we dive into these kind of the ideas behind what we're going to talk about today, and we're going to really focus on kind of the decarbonisation theme. But I want to give you some frameworks, because I think the frameworks help you as an investor help make decisions around your own type of investing and portfolio construction. So these are the 3 steps that we use as an ETF provider to choose what we're going to bring out to the market. But I think the important part here is that you also can use this high-level strategy to do this as well. So, this is all around ETF due diligence. I'm sure you would do your own ETF due diligence as well. In terms of looking at what's under the hood of the ETF, making sure it meets expects to meet your objectives around what you're investing in, how that pairs with other ETFs in a portfolio or stocks, whatever you have in a portfolio. This particular model here is more around the thematic side. So it's a bit of an add-on or a bolt-on to what is a traditional type of research model for ETFs or stocks, and it's pretty high level, but I think it stacks up pretty well, and I think it's probably somewhat self-explanatory as well. I don't think it's going to blow your mind, but it does work to put it on paper and understand it. So when we're thinking about bringing an ETF, and again, this is how I think, again, you should think when you're thinking about what type of investment you're thinking about, is how highly convicted are we that theme is true towards structural change. The difference between structural change and, say, a cyclical change is this true paradigm shift and big move around things like demographics and technology, these sort of areas, physical environment, whereas cyclical change is much more around, as we're experiencing now, higher inflation but lower inflation environments, or the interest rate cycle, something around those areas. So we want to make sure that we're convicted and that this is actually an observable long-term, and we talk about time frame in a moment, long-term, truly structural paradigm change. So if that's not the case, then we will not look to bring that theme out as an ETF. The second part is really important from our end, and again, I think from your end, but you'd hope that you would trust the level of the ETF provider you're working with, is that there needs to be a level of investability. So what does that mean? It means that there actually is a range of publicly traded companies. An ETF needs to really buy public companies. That's the whole point of the liquidity around that. But publicly traded companies that are also liquid. So if they're not liquid and it doesn't provide liquidity to the overall fund, well, there's an issue. Now, there's a couple of things that happen. I'll give you an example. A couple of years ago, there was this is out of the US, but a very large clean energy ETF by one of the majors, and it had a really good year. It had a really, really good year, to the point of up around 140% for that year. And what happens if that, if the performance really starts to stack up? Well, people start to sort of jump on board that bandwagon. As that sort of went along, what essentially started to happen, because clean energy was pretty new a couple of years ago in terms of some of the companies that were included in that index, it actually had a flow-on effect to the underlying companies and actually drove their share price higher. And when the the market started to exit out of that strategy, well, obviously pushed the share prices down. Now, you don't really want to be in a situation as an ETF provider that you're having flow-on effects to underlying companies in major ways. So we want to make sure when we bring out a theme that the companies have a certain level of market capitalization, so they're big enough and they trade enough that the impact of the ETF is not going to then have a flow on and have a large impact to the underlying share price. So that's really important as well. And then lastly, it's the time frame. So I sort of mentioned earlier around structural change. Structural changes don't happen once a year. They happen over the medium to long term. Really, they happen over the long term to evergreen nature. You want to make sure these themes are going to play out. Now there'll be short-term volatility. And we've seen short-term volatility in many themes over the past year. Like, really, we've seen a lot of pressure in tech. We've seen a lot of pressure in a lot of different areas around the markets. But, in the context, you're thinking about this as a long-term, you would hope that if you, again, have conviction that you're in investable companies, again, via an ETF or some companies, whatever way you decide to invest, that you can literally put this in the bottom drawer. You can bottom drawer this investment, and then you can look back in however many periods of time that you think it's worth and say, great, it played out like I thought. So that's the kind of the 3 steps to how we choose a theme. Again, I think that works for you. This is probably my favorite slide we'll do today. And I think it sort of stacks up this next slide, sorry, not this one here, but it's called the S curve. And the S curve is, again, different to the cyclical nature. So cyclical means it goes up or goes and goes around. This one is around the phases of adoption of technology. And this is a range of technology. This is not just the ones that we've listed on screen. But let me sort of explain it a little bit. Let me tease it out, because I think once we do, you'll have a good understanding of it. So how does this thing work? The idea is, as you can see, the S curve, that it has different phases, and those phases it starts out in the early days. So you've got the innovators of people who are coming on to, and this is the thing about who are the customers of these technologies. So you've got these innovators. These are the what we consider back in the day with some of these really nascent technologies. These sort of young cool kids who will take it on, but those technologies maybe aren't at the best at this point in time. They need to iron out quite a few bugs. They're probably not as proven as they could be. They're not broadly or widely accepted as they're going to 100% succeed. So you're taking on a fair bit more risk there. As you move up the curve, as you can see, that starts to ramp up in terms of the adoption, which is obviously then comes down to growth. Once it kicks into the early adopter phase, what you're seeing then is that some of those bugs have been ironed out of the technology. Some of those innovators have persuaded others, whether by word or mouth or by the technology getting better, to come on board, and that technology is starting to become worthwhile. So you're getting really, as early adopters come in, they start to really prove it up, again, iron out any more bugs. And then when it tips over again into the early majority, that's when the real growth kicks in. That's where the majority of the market, as you can imagine, globally starts to utilize this technology, and then you get huge amounts of sales. So what you usually see in the early adopter phase is the sales kick up, and then in the mid to late early majority, the sales turn into revenue. Sorry, the sales, which is revenue, turns into earnings. So what does that mean is that the profitability of these types of technologies is really significant at that point. And then as you get later on in the life of it, it starts to roll off into late majority. So still being used and still growing, but certainly not at any pace that is significant anymore. It's really kind of starting to get X growth. And then as the laggards kick in, well, then you would not likely see new technologies take over. And I think there's a couple of really nice examples on this slide to sort of bring it to life. The one that sort of stands out here is social media. So a really easy way to bring this to life is looking at Facebook, or Meta as they're now called, and to demonstrate that social media is essentially X growth, in that, that Meta, for example, have bought Instagram, they've bought WhatsApp, they've got Facebook, but the amount of users that they're probably bringing on every day is slowing significantly, if not plateauing. So what do they need to do? They need to reinvent themselves to get that growth back, and they've gone all the way back to that left side of the curve, and they're trying to advocate for the metaverse, but to do that costs a lot of money. So that's a really good example, I think, to show what types of themes will work. So that, but if we think about this again from an investment, purely from an investment parlance, rather than adoption, but investment, what you usually get as you push further left or push further right, the further left you go is you're taking on more risk that this particular technology doesn't work out properly, or some of those companies don't materialize very well, or the revenues don't return into earnings, which is profit. So you're taking more risk for potential for more return. So if you go further right, you're taking on less risk for potential for less return. So again, it's just this, I think, really helps. As an investor, you picture where you want to be on a curve like this. Where do you want to facilitate from a portfolio point of view? If you are adding thematics into that portfolio, where would you want to be? And there's some interesting ones in there. Lithium battery tech is one we'll discuss a little bit today. It is really just in the early adopter phase. It's really at the start. And I think it's pretty interesting around how Australia in general is very much probably even further back in the innovator stage in terms of the use case for things like battery tech and lithium, and certainly electric vehicles. So we'll go through a range of these today, but I hope, and we will publish this on our website, so you can go and grab that through there if you want to go back and look and think about where, again, you want to play these out. As I mentioned earlier, so the Australian listed ones that we have here are in orange, the blue, a broader range as you would expect in the US. So we are looking to grow what we have in Australia, and part of this is we'd love to hear feedback from investors like yourselves around what out of those particular themes on the screen right now, for example, resonate. So we have heard lots of feedback around things like data centers are still strongly growing in the face of inflation, similar to cybersecurity with Optus, and Medibank recently. So there's these sorts of things that maybe sort of resonating with you a little bit, that you might say, well, that's interesting. That may be something I can play as a thematic as well. Okay, so that's kind of setting the scene from the framework perspective. So what we're going to talk today a little bit about is, as one part of the theme, is this sort of decarbonisation mentality. And there's a range of ways to play this. One of the ways we're going to talk about, as is on screen, is the green metal space. And the other sort of area that obviously we can talk about as well is really around electric vehicles, and the lithium and battery technology space as well. So there's a huge areas. This sort of works together with commodities. It works together with technology, and it's renewable. So it's a real combination of all things here. But look, we know that in this space of decarbonisation, that it's somewhat unequivocal now that this is happening, in terms of the Earth is warming, and we've just come out of COP27. We know that we need to act. So I think at a personal level, and I'm not trying to, judge anyone who's doing or not doing whatever they need to do from a personal level when it comes to helping, but we know that from a government level, that it is now starting to be driven. So, we saw recently the Australian government, and obviously they sort of somewhat hung their hat on the net zero a little bit in the election, probably not enough, but and they did a little bit in the budget as well. Again, probably not enough, but I think we're talking here about what is pretty abundant evidence that there has been a large impact due to human activity that is going to cause an issue if we don't act now. And I think again, government's playing a role in that, and so that's a problem. This is another problem as well. So you've got a situation where the flow-on effect of this, and I think this is, again, I don't think there's anything that's new to you or going to blow you away, but I think there's a couple of interesting charts here, in that it shows the actual mounting cost of some of these particular disasters that are happening on the back of this link with potential climate change. So, in the US, they're talking about the number of disasters here on the left and the cost. And I've articulated this a little bit on the right here. The Californian bushfires, I call the wildfires, we won't judge them for that, but was a huge cost due to the land costs, and as was Australia. And these numbers are coming out of the Global Carbon Project, but huge costs, and even the floods that we've seen recently and continue to see. I feel sorry for anyone obviously still impacted by those up north or out west of New South Wales. And these aren't even included in those numbers, but these numbers are starting to stack up. So governments are really, and as our insurance companies, looking to solve these problems, because the back end impact of them is so significant. So you really want to try to front end solve it. And one of the ways to do that is to drive towards more renewable energy. So when we think about that, what are the ways, and what are the areas that we need to do? So one, we know we need to do solar and wind. They're probably the two easiest areas of technological advancements that have given us the ability to do energy generation that is not fossil fuel based. There's a range on this chart here as well. Nuclear is another one that we're interested in, but in comparison to fossil fuels, what we're trying to articulate here is, and this is about the investability of a theme like decarbonisation, to actually achieve the outcome that we need to go to solar, to go to wind. Hydro is obviously pretty well used in Australia as well with snowy hydro, but to go to really the solar and wind, which is where the real drivers are here, we need to mine a bunch more metals, and in particular things like copper, cobalt, a bunch of different areas that are going to certainly be really key. And I'll show you an example in a second for solar. But so we know that mining isn't great, but if we don't, in the case of these particular metals on the screen, if we don't pull these out of the ground and then utilize these metals to help build this infrastructure that is going to drive the renewable future, then we're in a lot of trouble. So, what we're giving you an overview of is okay, so we know carbonisation is essentially real. How am I going to actually invest alongside that theme, outside of doing what you should do on your own daily basis in terms of, being climate change focused, but how can I invest along that theme as well at the same time, grow my wealth in the case of, so support one side and potentially benefit from the other side. So this is around the materials needed. So if you use an example of a solar panel, this is the type of materials that you would need to drive an outcome for a solar panel in comparison. I'll show you a chart in a moment, in comparison to what you would normally have for traditional fossil fuel. So you need a huge range of what we're calling green metals or disruptive metals or transition metals. These are the metals that you need to utilize to build these types of infrastructure. So copper in the wiring, obviously the best conductor we have by far. Things like silicon certainly is a really key area for solar panels. It talks about the framing around aluminium and zinc and magnesium. So this is just one. This is saying 20 different metals. This is just one example, I think, and it articulates it reasonably well around the type of metals we need. So if we think about and go back a little bit and go, well, what were these metals traditionally used for? But then what are they going to be used for now? So I showed up on the chart before what metals are. So copper, I think, is a really, really interesting one. It's probably one of the ones at the forefront with lithium of, I could probably think a little bit closer to Australian investors' hearts around the big change that were happening. So as you can imagine, copper traditionally used in construction, in infrastructure. As I mentioned, it's one of the best conductors, if not the best conductor we have at the cost. But, if you want to increase conductivity, what do you need to do? You need to utilize a lot more copper. The same for aluminium. It is really, one of our best capacity constructors around building and framing and et cetera. And then we know about things like lithium as well. So lithium, certainly around batteries, and we'll talk about that in a moment. But, some of the other ones as well, rare earths, again, go into motors. Cobalt, certainly a key component of batteries and the cathodes in that, as well as nickel. So this is, again, an explanatory part around the shift and change around what, maybe if you were thinking about 20 years ago, even 10 years ago, around what a lot of these were used for, what they're used for now. Zinc, another example, galvanization, car bodies, street lamps. Now really thinking about wind turbines, you need to certainly highly galvanize those. So really, really key thinking about how these type of metals are going to change the game in terms of what we think about.
And I think they're really interesting slides there, Blair, as well, because it's sort of from an ETF provider point of view, you could bet on a particular solar company, or you could sort of, move further downstream and look at the materials that are going to pop up with these kind of new technologies.
Jack, I think you're exactly right. I think the situation with all type of investing, and we'll just take a quick pause on the slide here for a second, but is you've got a couple of choices. You can invest in a particular company, and you're thinking about, again, the whole risk return profile. Like, there is going to be more risk because there's what's called, try to use these words, these sort of jargon words, but what's called idiosyncratic risk. Essentially, what that means is you're getting company-specific risk that relates to things like what's happening in management. Is there issues in that particular country that the company's based in? Regulation around what it does, balance sheet, profit and loss. Like, there's a bunch of different things that are obviously going to have involvement around how that is. But your potential return for some of those companies is much higher than if you do diversify across a range. But then, what the ETF does as a solution, and this is where an element of trust, I mentioned this earlier, needs to be put into the ETF provider. They're building the right ETFs with the index provider for you, is that you're getting a diversified mix. So you're washing away some of that key company risk that you would get because you're diversifying, but you're probably also capping a little bit some of that, so that really big upside. And true, to your point, Jack, how you play this out, there's a bunch of different options. So if it's solar, for example, again, in the US, we do have an ETF that is based around solar. So it might have an element of some of the material companies that are involved, but also have solar manufacturers and silicon and semiconductor manufacturers. So it depends on how you want to play it out. Is it broad? Is it narrow? Is it specific? Is it geographical? There's a lot of different things you can think about around how to do that. So I think there's no right answer, Jack, with this. I think, you know, it is dependent on the actual investor and their style of investing. But I think what we're just trying to show a lot of these investors today is that the investment case somewhat stacks up for these types of investments.
Completely.
Yeah. I think this is just another quick overview of probably the why, because the next slide I'm going to show you is really the growth around some of these, but really the why, because it is around the renewables that are going to drive the change. So, you know, the energy production, again, is, you know, fossil fuel driven, and we've got some good slides coming up that I can sort of articulate from a revenue perspective, but energy production is you know, by far the biggest greenhouse global gas emission producer. You know, when we think about, we look at the carbon credits, which is a fund we will look to bring out in the near future. The carbon credits, you know, out of the US, out of Europe, and you look where the key buyers of those carbon credits are, again, where the biggest polluters are, and it really is in the energy production space. So, not to say that those other spaces aren't producing. So, you know, agriculture, forestry, etc., is certainly a key area, but energy is where the key driver is. So when we think about green metals, what are we sort of talking about? And I think this is about the scenarios of growth for those particular metals in terms of magnitude of growth. So, you know, when we think about things like lithium, and we'll go into depth on lithium, so I won't labour this point here, but, you know, there's a pretty good understanding that this might, you know, be a true paradigm shift change for a metal that probably wasn't used heavily back, you know, again, 15, 20 years ago. And the same can be said for things like graphite, cobalt, nickel. There is just step changes in terms of the demand expectation that is coming out of this. This is, you know, in terms of magnitude. And, you know, copper looks small on this, but I'll explain to you why I think copper is also a really interesting area of where this demand is. So this is to sort of show you again from the use case of some of these metals in the magnitude. So before, what I've sort of articulated is what the use cases are, but this is the actual magnitude of use, if you like, to compare them to what the traditional use was. So in a natural gas or coal-fired power plant, which we know we have in abundance in Australia because we have the abundance of the actual coal and natural gas under the ground. Things like copper, again, connectivity, things like nickel, you know, they're reasonably well used and important, but some of those, there's not a lot of actual coal-fired power plants getting built these days. There's existing ones being sort of enhanced, but not all new ones. Nuclear is an interesting space, and again, something that we're keenly interested in. One of the areas, kind of like electric vehicles in Australia, that we probably don't have a really good viewpoint globally on at this point, because we look at the Australian market, you know, nuclear is not big on our agenda whatsoever, but globally it certainly is, with the understanding of what it does for from carbon emission perspective, obviously that being very, very low, and two, you know, the cost effectiveness of that technology now as it's got better and better over the years. But the ones I guess we'll focus on, and the ones I think that are articulated easily here in this chart on the left, is the solar and the onshore and offshore wind, where, as you can see with the copper, and this is what I was articulating that point just on the previous slide, it is like, you know, double to quadruple the amount needed of copper for these technologies. So if we are really going to, you know, again, going to COP27, if anyone's had the fun of trying to watch the word fest that was, knows that, you know, and there's actually a nice summary document that you can get if you go to the COP27 website that sort of articulates what they're trying to achieve out of this. It's not perfect, and it's certainly more around developing nations than developed. But one of the things I articulate is that the expectation is that the spend on renewables is going to be so significant over the next sort of 5 to 30 years that the need for these types of materials is going to increase. So copper, as you can see here, again, with zinc and nickel, they're really going to be core to the drive of the move to renewables. And the same can be said for EVs. You know, it's between double and triple the amount of copper that's needed for EVs. And then you need a bunch of different other materials. One of them is lithium. Looks small on that chart, but, you know, obviously from a cost perspective, it's significantly higher, as you do in things like cobalt and graphite, etc. So again, like, if we're just trying to compare them think and put this in your mind around how the differences are to what we were doing 10 years ago to what we're doing now, and how you think about that for, when you think about the future investing. All investing is essentially looking into the future, how you play that out now. I mentioned this chart earlier around the revenue. This is, I think, the important part around the revenue. So the revenue from the coal, is obviously still significant. We've seen the coal price of some of those stocks that you might have traded yourself, the Whitehaven, Stanmore's, etc., have had a really strong run. Starting to come off a little bit now, but had a really strong run. And the revenues are still high. The revenues are still high. That the need for copper is still high globally. I think this is, again, a point that we think we probably should make. Investing in this, it's not a one or the other. It can be mutually. You can buy coal and profit from possibly the short-term fluctuations of coal or the medium-term fluctuations of coal, and still then buy for the long term. Invest alongside renewable energy type of scheme. So it doesn't mean that you have to do one or the other, because investing is taking things in front of your face and understanding what you think is going to be right for you to invest in a portfolio. Doesn't mean you have to neglect completely everything. Now, that if you're an ESG type investor, understandably you might not invest in coal at all. But for those who are more focused on purely on just returns, well, that doesn't mean that just because you're a believer in renewables doesn't mean you have to walk away completely from coal. But secondly, if you look here again, the revenue changes. So, it's all good to say the demand's there, but is it going to flow through to revenue? And then is it going to flow through to profitability? I think the expectation is, based on our research, based on the International Energy Agency's work, that it will. So the expectation is that you will see the demand flow through into revenue, and then obviously that flows through, I mentioned earlier with the S chart, into earnings, which is the profitability that gets either paid out in dividends or puts back into the company to reinvest. For a mining company, a new mine, they might buy a new mine or buy a new company, as we just see now with BHP and Oz Minerals. So this is the renewables chart. I think this is anyone. If I haven't taught you anything, I've said the S curve about 1,000 times this webinar. So hopefully you can see this picture and see the S curve for what it is. This is around the renewables uptake. So again, this is just a technology. It is the adoption of this technology. But this has really been driven, again, COP27, government-led. This is somewhat mandated. And what I try to articulate here with the slightly dotted orange line is that the acceleration has actually gone up a little bit since we produced this chart back in 2021 because of the energy crisis, because we know the independence of the European nations around their own energy. Well, they're struggling with that, and they're going to continue to struggle with that unless they can produce their own energy. They don't want to be reliant on other nations like Russia. So what they're trying to do is they're trying to drive down a couple of avenues, one being the renewable space, solar and wind, and the second being nuclear, where they can control that themselves, much more so they control a pipe that's getting sabotaged by Russia or coal. So certainly, I think this could accelerate even faster, and may do so again at the back of things like COP27. But the EU is still having these conversations around this, and that's probably one of the biggest drivers of this space. If you think about the spend, and I mentioned earlier, in the Australian budget this year, there was an extra spend of around 25 billion for the build of renewables. The total spend in Europe is something in the circa vicinity of 500 billion on this space. So it's a huge, huge spend. And what we know out of Europe is they don't have a huge amount of commodities, but thankfully Australia does. So we should also, as a country, with BHP, Rio, benefit out of that, as does some of these South American countries with the copper that they have as well. So that's I think the first part of this, Jack. I think we'll I want to move on next to more on the again technological side, but the future of mobility. Mm-hmm. So again, I think a core decarbonisation theme here, and probably one that I'd say many of your investors here probably are more familiar with, because we know that lithium, being the multiple Australian stocks on the Australian market, is certainly a driving force for what has been a very tough year for investors. That's one of the few bright spots I think that many investors have had. So I think they're probably somewhat familiar with this theme. But again, what I'm trying to sort of provide here is more, here's a thematic overview of it. and let's sort of, understand what that means and what the actual somewhat outcomes are, so that you understand what that means for you as an investor. So, as you know, lithium, I won't label this point on lithium at this point, because I think this is something that many probably investors know, but it certainly starts here in Australia. We have probably some of the best hard rock deposits globally. The other side of that is brine deposits over in places like Chile and South America. As it moves down the curve, and this is again how you think about thematic investing. You can either buy the companies, nothing wrong with buying lithium companies or other parts of the curve here, but this is about, when you think about, again, this is where ETFs can help, bringing the whole thematic into one. So you move down this curve, you go, okay, well, I can buy lithium. I also can, allocate towards the processing of that lithium. And then you move even further down. So how do you move that lithium into actual battery construction, so the cathode and anode production, then the actual cell manufacturing? That's heavily done in China, by far the leaders in China. I know that some of our Western Australian friends are in some of these areas, like the Pilbars and the MinRes companies, are trying to think, oh, we can do this. I think we're probably a little bit far behind for that. And then you even go further downstream and you go, well, what about the actual electric vehicle makers and also the traditional makers as well? So the current car makers, and I've got a slide on that later. And then lastly, for those of you who are in Brisbane or Adelaide, you would know that there is scooters everywhere. Even in Sydney, every second kid around where I live here has an electric bike. I don't know how their parents afford it, but they've all got one. So you've got a lot of other forms of use of this. But this isn't, again, new news, but this is, I think, the next slide I'm going to show is why this has changed the way the market thinks about it. So if you remember back in 2015, there was a bit of a step change around the lithium price. It sort of had a run and then it fell off because maybe it was a little bit early days. They thought that the electric vehicle sort of revolution was here, but probably was a little bit early days, as I said. So, but this is the why, for a lithium perspective, that it is so heavily driven. So smartphones, 5 to 7 grams. Look how big your phone is in comparison to what is a car battery, which is 40,000 to 80,000. So that is a significantly large boost. And if the expectation is that on the right slide here, part of the slide, that the demand increases significantly, we know it is. And I think, for those of you who've been to places like Europe or California recently, you've seen a million Teslas on the road. That's just one area. There's, you go to China, it's now nearly cheaper to buy an electric vehicle in China than it is to buy a traditional vehicle. So their demand, again, think about how many people there are, 1.4 billion, their demand is going to be significantly higher than everywhere else in the world. But as Europe and then as the US gets bigger and bigger, you've got a situation, sorry, this chart's cut off, one of the US is that sort of dark grey, and the rest of the world's the orange. I think Australia probably misses this a little bit because there's just, you definitely see the odd one, but they're not around like they are in some other parts of the world. I think this chart articulates it really well. So, you've got places like Norway, Sweden, these are penetration rates are huge. China is getting better and better and better, and this is going to continue to look at the growth expectation there for China is massive. And then look at Australia. Like it's actually quite poor. I know the government is trying to, the Labor government now is trying to do a little bit around subsidies, rebates, and things, and really it's around infrastructure as well. Infrastructure here in Australia lacks significantly around. My father is buying a new car recently, and I was trying to implore him that bite the bullet and buy an EV now. I know they're a little bit more they're a bit more costly, but you'll be ahead of the curve, and it's obviously beneficial. But just too much range anxiety, too much issue around charging stations, having to plan your trips just to go wherever you want to go. It's just it didn't stack up. So, I think it's a real shame that Australia is at the bottom of that chart. And I do hope we'll get better as time goes on. And this next slide, I think, is why we will get better. So it's the Tesla of the world, BYD's out of China. I think I have driven the change, but this is where the change is going to be and going to come from is two things. One, the regulation that's getting driven, and not really in Australia because we're just not ahead of the game here, but especially out of Europe and China, that is forcing these companies to make a huge shift change in their expectation around their electric vehicles. So this is a bit of a busy slide, but you can sort of see here that these large manufacturers, so Daimler and Mercedes-Benz, by 2025 have a 50% target of expectation and have committed, nearly $70 billion US towards EVs. I know that I heard recently that VW, for example, in Australia, they expect to be nearly all Australian vehicles electric by 2026 or 2027. So this is where the true shift is going to come and going to move. So, again, that stacks up. So we've just talked about the demand of EVs, and we've talked about why that demand is increasing. What's the flow-on effect of that? Well, the flow-on effect of that is that the lithium price, as I mentioned back in 2015, and sort of jumped and sort of fell off. This might be the real deal, and the lithium price has spiked so significantly that, well, look, we know that the share prices of these companies have jumped. Some of them 100-fold. You'd be up 200, 300% for some of these ones, these smaller ones, on a 1 to 2 year basis. So the question that we get consistently is this price sustainable? Can the electric vehicle manufacturers accept this price? No, there's a couple of things here. One is the technology in battery manufacturing has got significantly better. Getting out of China, there's a manufacturer called CATL, which is doing ridiculously amazing work in this space, and using less lithium and getting much more range out of their batteries, which is incredible. So, is it likely to stay here? Probably not. It probably will start to come back to a closer equilibrium. But I think the numbers that have been sort of touted by, not just me, but by things like Citigroup and UBS and Credit Suisse, at around 50,000 are probably quite sustainable. So at 50,000, though, as an example, and it's certainly not, don't quote me on that number, but that's the numbers that are sort of coming out of the market. What does that mean for the supply and demand imbalance? Because really what this spike has come from is because the demand's high and the supply's not there. This is a very historical economic function. Well, from a lithium point of view, we think that the supply starts to get better. It has got better this year, it gets better over next year, but then again, with that demand kick up, well, you're always in a situation where that it starts to fall away again. So the imbalance is still very much the demand outstripping supply. So again, this is why this is certainly a long-term theme, thinking about how you play the theme from a lithium perspective, also from an EV perspective, from a battery manufacturing perspective. Again, this is encapsulating what the theme is and how it's long-term. So to finish up, Jack, and I know we're getting close to time here, mate, but these are where we, again, see these on the S-curve. We talked about a little bit, very, very, very briefly on uranium. Again, it's certainly down the track, but you can see a lot of growth, as has copper, but again, step changes. But again, with lithium, it's very much early days. It is at the forefront of where we are, because you can look at that chart. It wasn't very heavily used, and now it's, what's it been, 2 years? So it really is a big deal around how these things are changing and moving over the short term in for the long term. So I don't want to labour the point around products specifically, because I don't think that's what I'm trying to talk a little bit about, the themes and how to play them. But there is a couple of options for you if you do want to play these themes with what we have, as I mentioned on that first S curve. We have Y, which is purely a copper miners ETF. That's very much a global play. Again, if that resonates with you, I think that last part of the slides there, Jack, with and many of your investors probably know about ACDC, which is encapsulating that whole part of the curve to the battery tech, the lithium, the car manufacturing. We've also brought out the green metals, which captures all of those metals. So you've got copper in there, you've got lithium in there, you've got cobalt, zinc, aluminium. We didn't talk about hydrogen, but it is sort of part of our decarbonisation range. And then we've got a couple other ones coming out. We've got a uranium ETF, which again, we have a lot of information on through the US website, because it's obviously a US-based ETF at this point. And a new one that's, I think, quite a unique area to play this theme, but is with the global carbon credit ETF, which is certainly based out of Europe and the US, more so than Australia, which again, who are long-term markets, 16, 17-year markets that can demonstrate, quite what they call uncorrelated returns to the equities and the fixed income, which we've seen have been tough the last couple of years. So, Jack, I think definitely hand over questions. We might be running up into time though, but hopefully that articulated a little bit about how we think about this type of theme.
Yeah, I think that was great, Blair. Thanks so much for taking us through that. I think to sort of dive into the themes there, it's really, really fascinating. And I didn't say it at the start, but if our audience does have questions, there is a Q&A box at the bottom of your Zoom screen there, so please do use it. We have Blair here. Pop in any questions you'd like to ask him. just while you're doing that, I'd sort of love to ask, I know we saw your beloved S-curve a couple of times there, and I think it's a really sort of good way to look at some of this. So could we actually go back to the slide?
Yeah, let me do
with these technologies on it, just because I think it'd be great to, after we've sort of gone through this, to kind of put it in perspective where green metals and where EVs sit on there. Oh, perfect.
Okay. Yeah. So I think, okay, was there any particular ones you want to have a quick chat about, Jack, or is it just? I know. Look, as I said, this is my favourite slide. Anyone who will give me 2 seconds, I'll put this in front of their face.
It's I mean, I guess from sort of, I guess, an investor point of view, you've sort of alluded to it before. I mean, the further left we are on that curve, typically the more sort of risk I guess there is, and sort of as it kind of goes through a growth phase, we sort of get into the later point of that technology. But as an investor, when you're sort of, I guess, looking at this S curve, is there sort of a sweet spot on there where things become quite interesting, where we sort of have more proof of technology, where maybe we're not at that major growth stage yet? Like, how do you kind of sort of I guess, as a fund manager and as an investor, kind of I guess, look at the tech on this curve?
Yeah, look, I think it's a difficult one because every investor is going to have a different risk profile. And for those, I guess this is, your audience, the audience that you have through Superhero is very much self-directed, which is great. What I would implore you all to do, and I know that investor behavior, investor psychology has got much better over the last few years with with things like podcasts and information on the internet. But take a step back and think about what your strategy is for the investment. Think about how, when you buy these things, I'm not trying to give you a lesson here, Jack, but just go with me for a second. Think about when you buy these things, how they pair together and how they pair with other things in your portfolio. I think one of the common things we see, especially with thematics, is that they catch your eye a little bit, and you start sort of just dumping them in a portfolio. And what happens over time is that you get a pretty solid overlap that you might have. So I'll give you an example. If you were to buy the lithium battery tech, which has a bunch of electric vehicle exposure, and then you would also buy an electric vehicle directly ETF, or you want to buy Tesla yourself, well, then you're doing a little overlap, and you're sort of diluting the effects of some of those in how it works as a combination. But I don't think there's any sweet spot, because, as I said, every investor is different. Some investors might have a high risk profile and want to build some of those earlier, more nascent technologies into their portfolio, and they have a long-term time frame. They might be younger, they're in their 20s, so they've got 10, 15 years for it to play out. Or if it's a post-retiree self-managed super fund, it might not be as suitable to do that, because the time frame is not there for you, not sort of so focused on growth. So there's not a really perfect answer for this. But look, the curve is where you're getting it. Where you're getting the curve is, if you look at hydrogen, for example, in particular green hydrogen, which is our furthest left, what you've seen recently is Twiggy Forrest trying to pump a lot of money into this, and trying to drive adoption globally, and it's not easy. It's not easy. It's going to cost a lot of money to get it up and running. So, but if it works, well, then it's going to potentially accelerate off that curve. I think the other thing is with this curve, and I probably didn't mention this earlier, and I should mention it now. It's not this nice uniform, this plays out over 10 years and everything's the same. Like every technology has a different shape of the curve. They have to take the where the growth part is and how long it takes. So it's not perfect. What we have found is that the steepness of the S curve in general is somewhat faster now than it used to be. There's a nice chart, if you can go and search on the internet, and it shows traditional types of technologies like the fridge and the radio and all this sort of stuff. And that it took a lot longer for the adoption of that technology. Where today, think about the internet or mobile phones, it's much, much faster. So again, this is not a perfect representation. It's this nice elongated curve, but it depends. So you might get hydrogen, it might move, as an example, right? It might move really fast and be, in the early adopter phase really quickly, compared to, say, the blockchain, which has had setbacks, like all those sorts of things. There's no perfect answer, unfortunately. And this is where I think the research of the investors on Superhero is going to be really important, because that's going to think about how you long-term you are, and also how these things fit together for you.
Yeah, and I think that's a great point to make as well, that, you know, every investor has to sort of assess their own needs and, you know, their timeframes and all of that, the risks they're sort of willing to take. We have a great question from Remus here on the Q&A. He's sort of been interested in, you know, some of this clean energy, sort of the clean energy thematic. He's asking, you know, when it comes to something like nuclear energy, for example, he sort of wants to know your thoughts on, I guess, the risks associated with that, such as, you know, sort of, I guess, a global fear of nuclear energy, a lack of interest in Australia. Could you sort of speak, I guess, to sort of maybe, I guess, how nuclear kind of fits into that clean energy picture?
Yeah, I think it's one of those. It's a really interesting space. As I said, we are going to bring out something that's focused on that, and I think it is hard. Because, you know, when you think about the exposure to uranium, I think is bang on in that, especially in Australia. I think if you stay local to home, the perception of, you know, this I haven't heard, and tell me if I'm wrong, someone probably on this call probably knows better than me, but I haven't heard any talk of a nuclear or any expression of interest of a nuclear power station coming to Australia at any point in the near future. But if you look at something like China and Europe, that's look, this is the other part. This blows me away. Even Japan is now more open to nuclear again than it previously was. So the expectation is that this, again, around energy independence, which I think, you know, we're just lucky in Australia. We've just got so much coal and so much gas. We ship most of it out. Like we ship most of it out. We ship basically everything we own out. I think I don't know if you actually saw there's a line. Going off topic here. I tend to do that. Apologies, but you know, Australia is so fortunate. You know, every $10 increase in the iron ore price, this is our biggest export, obviously, increases the budget by $500 million. So, like, you know, it is, you know, the exports that we have probably makes us a little bit resilient to some of these things. But you know, there is actually a huge interest in nuclear in global markets, and China is number one. And I don't know the exact, I can't remember the exact number. I was looking at this recently, but around the amount that they're actually building and the amount that they have proposed to be building post that as well, and the extension of the life of many of them existing ones is really significant. So, you know, the uranium price as a proxy for that, you know, has had a bit of pressure on it, but has started to sort of move a little bit higher on the back of that energy independence mentality that's starting to come out of what's happening in Europe.
Yeah, it's certainly, I think now in the spotlight much more than maybe it was a few years ago. I think that just about does us for time. Thanks so much for taking the time to walk us through this, Blair. It's been really informative. I know we had a lot of excitement around this webinar, so it's sort of great to dive into those. Just a reminder to our audience, a recording of this will be on our YouTube account, will be online probably later today. If you want to review any of the material Blair's gone through, I also know Global X has some great content up on their website, which we'll also share with you. So if you do have any sort of further questions or queries, or you just want to sort of do more research, we definitely encourage you to do that. But thanks again, Blair, for running us through and presenting, and thanks to all of our audience members for joining us.
Thanks, Jack.
Excellent. Thank you. Have a excellent end to your Tuesday, and we'll talk soon.